The winds of economic change have once again swept across the German industrial heartland, casting a pall of uncertainty over Europe's largest economy. The recent plunge in industrial production, coupled with a slump in factory orders and dampened investor sentiment, has sent tremors through the financial world, prompting us to ponder the fragility of our interconnected global systems. At first glance, the 2.5% drop in German industrial output for May might seem like a mere statistical blip, a fleeting hiccup in an otherwise robust recovery. But strip away the veneer of complacency, and a more disconcerting narrative emerges, one that speaks to the delicate balance between domestic resilience and global interdependence. The German economy, long revered for its export prowess and industrial might, has found itself ensnared in a web of headwinds, both internal and external. High interest rates, a byproduct of the European Central Bank's efforts to rein in inflation, have cast a shadow over investment and consumer spending. Meanwhile, waning foreign demand, a consequence of the lingering pandemic-induced disruptions and geopolitical tensions, has hobbled the export juggernaut that has been the bedrock of Germany's economic ascent. But this story transcends mere numbers and statistics. It is a tale of interconnectivity, where the fate of a single nation's industrial sector can reverberate across the global financial tapestry. As the world's fourth-largest economy and a linchpin of European stability, Germany's fortunes are inextricably intertwined with those of its neighbors and trading partners. The automotive industry, a bastion of German engineering excellence, has been particularly hard hit, with output plummeting by over 5% in May. This downturn reverberates far beyond the factory gates, rippling through a vast network of suppliers, logistics providers, and ancillary services that rely on the automotive sector's continued vitality. Yet, amidst the gloom, there are glimmers of hope. The service sector, buoyed by a resilient consumer base and a strong labor market, continues to prop up the German economy. Private consumption, fueled by robust wage growth and an easing of inflationary pressures, is expected to be a driving force in the latter half of the year. The German government, cognizant of the gathering storm clouds, has acted swiftly, sealing a delayed 2025 budget that includes measures to stimulate growth and buttress the economy against external shocks. But the true test will lie in the ability of policymakers and industry leaders to navigate the treacherous waters of global trade tensions, supply chain disruptions, and shifting consumer preferences. In many ways, Germany's industrial stumble serves as a microcosm of the challenges facing the global economy. It is a stark reminder that no nation, no matter how mighty or prosperous, is an island unto itself. The intricate web of trade, investment, and financial flows that binds us together can just as easily become a conduit for contagion, spreading economic malaise from one corner of the world to another. As we contemplate the implications of Germany's industrial woes, we must also ponder the broader lessons they impart. In an age of heightened uncertainty and volatility, resilience and adaptability must be the watchwords not just for nations, but for businesses, communities, and individuals alike. The canary in the German coal mine has sung its ominous tune. The question now is whether we heed its warning, or remain willfully oblivious to the gathering storm on the horizon. For in the realm of global finance, complacency is a luxury we can ill afford.